Investors seem to have decided not to focus on potential trouble spots, the downside from tariffs, until it matters. What will cause that to matter again?
Well, I think obviously the August 1st latest deadline matters. We'll see whether that gets extended again. Second quarter earnings season matters because analysts are essentially forcing companies to try to put meat on the bones in terms of those companies that are impacted by tariffs. What has been the impact to date? Are they planning on, or are they eating it in profit margins? Are they passing it on to consumers? What is their pricing strategy? What is their pricing power? So I think we're really in the meat of when we're going to start to maybe quantify some of this a bit more. And then I think, Fed policy as well. I have a bit of a contrarian view, Scarlett. I actually think that part of the reason why the market has done fairly well is because the Fed is not cutting, not the market anticipating that the Fed is going to cut. Neither side of their mandate suggests it's appropriate. And I think that also maybe is why there's a bit of calm in the bond market as well.
So when you say that the market's doing well because the Fed is not cutting, that's because it's a reflection of the solid economic fundamentals?
So far, anyway, solid economic fundamentals, not to mention the fact that we don't have tight financial conditions. They're actually fairly loose. So you've got the dual mandate, neither side of which is suggesting the Fed should imminently make a move here. The inflation is not accelerating significantly, but it's not down toward the Fed's target. The unemployment rate has come down a bit. There's enough resilience in the labor market that side of their mandate is not suggesting they should do something. And then the other issue, of course, is we can talk about the benefits perceived or otherwise of taking short rates down. But this notion that that is going to benefit, say, smaller caps or mortgage rates is only if you see longer term yields move down commensurate with shorter term yields. We could have a repeat of what happened last fall, where when the Fed cut the Fed funds rate by 100 basis points over that same period of time, almost to the day, you saw a 100 basis point increase in the 10-year yield. That's the feeder into the equity market, into corporate financing, and into things like the mortgage rate.
Well, let's talk a little bit more about corporate America through the lens of earnings, because we're really getting into the meat of earnings season. We have some of the big tech names taking the stage tomorrow, and it seems like so far it's pretty rough out there. You consider the reaction function that we're seeing to the companies that missed. Bloomberg Intelligence estimates it's the harshest punishment in about 3 years' time. Liz Ann, what does that say about the state of sentiment at this moment?
It's interesting because the actual earnings bar has been set relatively low heading into second quarter reporting season. You had a very strong first quarter reporting season. When all was said and done, earnings were up 15%, which is almost double what the expectation was at the start of first quarter reporting season. But there was no extrapolation of that into the remaining 3 quarters of the year. So arguably, numerically, the bar has been set low, but I think psychologically is where the bar has been set higher. And that's why you're seeing stocks of companies that have missed disproportionately hurt on the downside relative to the rewards accrued to stocks of companies that have beaten estimates. And I think that kind of trend is likely to continue. More punishment for the misses.
That's a really interesting separation, that maybe when it comes to pure numbers, the bar was lowered heading into this season, but the psychological bar is maybe much higher. So that's the missing conversation. When companies miss, they're getting disproportionately punished in this environment. What about the companies that actually meet or exceed expectations? Are we seeing on the flip side those companies being rewarded?
No, to a mild degree, but nowhere near proportional to how much the misses are getting hurt. And that's not a brand new trend this quarter. That's been the last couple of quarters. And I don't think we see an improvement other than maybe extreme beats on the upside that go well beyond what the analysts were expecting, provide an outlook that is rosier than what was anticipated. Aside from that, I would expect to see muted impact on the stocks of beats, much more of a focus on where are the hits coming.
Liz Ann, you had mentioned earlier that the economy is doing well, and in part because the Federal Reserve is not cutting interest rates. It also, you've mentioned
the market doing well.
The market doing well. Excuse me. Yes. Yeah. Thank you. I misspoke there. But you also noted that the rally that we've seen since the lows of April has retail traders' fingerprints all over them. And I'm curious in terms of what you're seeing that proves that, and what that might say about the durability of this bull market.
Yeah, you can look at the factor level and you can look at the basket level. So very popular baskets put out by Goldman Sachs. You can array them and look at where under or outperformance is. And it's an interesting array since the closing low on April 8th, because the biggest outperformers at the basket level are things like non-profitable tech, retail favorites, heavily shorted stocks. On the flip side, the biggest underperformers since the April 8th closing low are baskets like the defensives and bond proxies. So there's a bit of a lower quality tilt to what's working, but it's a lot of those cohorts that are favorites of the retail crowd. I think what's also interesting about the heavily shorted stocks also doing well, it's suggestive of the move by retail traders to buy the dip in the intraday lows on April 9th and continue to buy on the way up actually forced some repositioning on the part of institutions that were left somewhat flat-footed when that rally started. So that short covering has been part of what has propelled the market higher. Those are arguably still lower quality stocks, but that's an area where you see this blend of retail trader footprints and maybe what that's forced institutions to do.
So how does that affect people's positioning going forward? If you're observing that and seeing a tilt towards lower quality names, how do you think one should position themselves for the upcoming weeks where we can get a lot of news when it comes to tariffs?
So I think in the aggregate, the pain trade is probably still higher because institutions are not positioned in risk-on mode. That said, there is a lot of complacency, and I think the market would be subject to another pullback. We've had mini ones, obviously the big one from mid-February to early April. I think the market might be prone to that given complacency if we get some sort of negative catalyst. So I think the way to think about positioning is I would, using traders lingo, I would fade the low-quality areas that have done well, take profits there, lean in up the quality spectrum. Even if the market continues to rip, they may not be the biggest outperformers, but they'll continue to do well in an absolute sense, but probably also represent some ballast in the event you get some sort of catalyst-driven pullback in the market or correction in the market. That was certainly the case during that mid-February to second week in April period of time. So fade the low quality, lean into the high quality.
It's a delicate needle to thread, right? Because the risk, as you say, the upside risk, the pain trade here is a big move higher, but at the same time, you want to fade some of those lower quality names. But what does higher quality mean to you? Because for a lot of investors for so long, that has led them to the tech sector.
Yeah, and I think that there's still plenty of representation within some of the high-flying, growthier sectors like comp services and technology. The factors that we are focused on that would arguably have that high-quality umbrella around them, some of them are generally high-quality factors like strength of balance sheet, strong free cash flow, but maybe more targeted high-quality factors for the unique period of time we're living in right now. So stability or strength in profit margins, forward-looking positive outlook from an earnings perspective, so positive revisions, high interest coverage. So some of those balance sheet related high quality factors, I think, are where you want to focus. Almost the way, I've been doing this almost 40 years, thinking back, 20 years or so, when GARP was the popular acronym, growth at a reasonable price. I think you want that blend. You don't want to sacrifice growth in order to find value. I think you want to look for the blend of those. But apply that analysis and screening across all 11 sectors. You'll find opportunities in the growthier sectors.